Imagine this. You finally decide to invest your hard-earned money. You open your investment app, and suddenly you're faced with two choices: stocks or ETFs. Everyone has an opinion. Some people say individual stocks create millionaires. Others claim ETFs quietly build fortunes over time. So who's right? Today I'm going to explain the real difference between stocks and ETFs using simple language and real-world examples. By the end of this video, you'll know which investment fits your goals and which one has the highest chance of making you wealthy. Let's begin. What are stocks? A stock represents ownership in a single company. When you buy one share of Apple, you're buying a tiny piece of Apple. If Apple grows, your investment grows. If Apple struggles, your investment falls. Simple. Think of stocks like betting on one athlete in a race. If that athlete wins, your rewards can be huge. But if they lose, your investment can suffer badly. History has shown us many examples. Companies like Apple, Microsoft, Amazon, Nvidia, and Tesla created enormous wealth for long-term investors. Someone who invested $10,000 in Amazon decades ago would now own investments worth millions. But here's the other side. Thousands of companies have failed completely. Some went bankrupt. Others never recovered after economic downturns. Individual stocks can create incredible wealth, but they also carry significant risk. What is an ETF? Now let's talk about ETFs. ETF stands for Exchange Traded Fund. Instead of buying one company, you buy hundreds or even thousands of companies at once. Imagine going to a fruit market. Buying one apple is like purchasing a single stock. Buying the entire fruit basket is like buying an ETF. If one fruit goes bad, the basket still has plenty of good fruit. That's diversification. One of the most popular ETFs tracks the S&P 500. That means you're investing in America's 500 largest companies: Apple, Microsoft, Amazon, Nvidia, Meta, Google, and hundreds more, all with a single purchase. That's why ETFs are considered safer than owning only one stock. Risk comparison. Now let's compare risk. Suppose you invest $20,000 into one company. If that company loses 50% of its value, you've lost $10,000. That's painful. Now imagine investing the same amount into a broad market ETF. Even if one company crashes, hundreds of others continue growing. Your overall investment is much more stable. This is why professional investors always talk about diversification, because nobody can consistently predict which company will become tomorrow's superstar. Even experts get it wrong. Reducing risk is one of the smartest ways to grow wealth over decades. Return potential. Now comes the exciting question. Which investment makes more money? The honest answer is, it depends. Individual stocks have higher upside. If you correctly choose the next NVIDIA before everyone else, your returns could be extraordinary. Some investors earn 10, 20, even 100 times their original investment. But very few people consistently pick winning stocks. Most investors underperform because they chase trends, buy at market highs, and panic during market crashes. ETFs usually don't create overnight millionaires. Instead, they steadily grow over many years. Historically, diversified U.S. stock market indexes have averaged roughly 8 to 10% annual returns over long periods, although yearly results vary. That may sound boring, but compound growth is incredibly powerful. Consistency often beats excitement. The power of compounding. Let's look at a simple example. Imagine investing $500 every month. Not once, every month. If your investments grow at an average annual return of around 10%, after 30 years, you could have well over $1 million. And here's the amazing part. Most of that money didn't come from your deposits. It came from compound growth. Your investments begin earning returns. Then those returns begin earning even more returns. Albert Einstein supposedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the principle remains true. Time is the greatest advantage an investor has. Which one is better for beginners? If you're just starting your investing journey, ETFs are usually the smarter choice. Why? Because they're diversified, lower risk, easy to manage, and they require far less research. Stocks can still play an important role. Once you understand how businesses work, you can dedicate a small percentage of your portfolio to companies you truly believe in. Many experienced investors follow this strategy. They keep most of their money in diversified ETFs and invest a smaller portion in individual stocks with strong long-term potential. This gives them stability, while still allowing for higher growth opportunities. So, stocks versus ETFs. Which one will make you rich? The truth is, neither investment guarantees wealth. Your success depends on consistency, patience, and staying invested through market ups and downs. Stocks offer bigger rewards, but they also carry bigger risks. ETFs offer slower, more reliable long-term growth. The investors who become wealthy aren't usually the ones chasing the hottest stock. They're the ones who invest regularly, ignore short-term market noise, and allow compound growth to work over decades. Because in investing, getting rich isn't about finding the perfect investment. It's about sticking with a smart strategy long enough for it to succeed. If you found this guide helpful, don't forget to like the video, subscribe to the channel, and share it with someone who's beginning their investing journey. Thanks for watching, and I'll see you in the next video.